Welcome to this video on stock exchanges. In this video, you will learn about the central entity in the financial markets. Specifically, stock exchanges and their functions. How do trades happen on the stock exchanges? And various facilities provided by stock exchanges. You have already been introduced to stock exchanges in previous videos. However, this video gets deeper into the topics you have learned so far. A stock exchange is a facility where market participants such as traders and investors can buy and sell financial instruments. It is also known as a stock market, aka share market, or bourse, or market. They provide a regulated, secure, and legitimate environment to trade financial securities. Stock exchanges are the primary entity in the financial markets, which work with every other entity. Operating under the defined rules as stated by the regulator, the stock markets act as both primary and secondary markets. They do not own any shares. Instead, they act as a market where stock buyers connect with stock sellers. Now that you understand what stock exchanges are, it's time to learn various functions performed by them. Some of the functions that stock exchanges perform are: they enable companies to raise capital. They ensure fair pricing of listed securities. They provide safety to transactions made by investors. Maintaining liquidity, that is, any trader willing to trade gets instant access to place orders, which should get executed at the fair price. Stock exchanges often create and maintain various market-level and sector-specific indicators known as indices. Stock markets ensure that it supports various types of participants such as investors, traders, market makers, and so on, and implement necessary measures to protect investors' capital. Knowing various functions of stock exchanges, it's time to understand how trades happen there. When a trader places an order to buy shares via a broker, the order goes to the broker server, where various risk management checks will be carried out. After that, the broker will pass the order to the exchange. If the investors have direct access, they themselves are often responsible for risk management checks. Once the exchange receives the order on their servers, it will try to match the order with the order of the seller, who is willing to sell shares in the required quantity and price. This order matching results in the order execution, that is, the buyer is obliged to buy shares and pay the amount, and the seller is obliged to sell, and in turn receive the amount. On most of the exchanges, the order matching happens based on the price-time priority. That is, the buy order with the highest price will be executed first. If there are multiple buy orders with the highest price, it will be executed on a first-come first-served basis. For sell orders, the lowest price will be given the highest priority. Next, you will learn the facilities provided by stock exchanges. Apart from providing a facility to trade in various financial instruments, exchanges provide facilities such as data distribution, that is, exchanges provide real-time market data, as trades happen to those who have subscribed for it. Clearing membership, that is, exchanges appoint independent entities for post-trade work. Colocation facilities, where exchanges allow trading firms to keep their trading server in the same network as that of the exchange servers.